Hi guys, welcome to the third episode of Ask Joy. As the title suggests, today I'm going to share on how to spot projects that are likely to reduce in pricing. So unlike the resale market where there are multiple stakeholders, in the new launch market there is only one stakeholder and that is your developer. So how a developer does his pricing is crucial to you as a buyer because this will have an impact on how much profit you will earn or even how much losses you will incur. So understanding the next 3 pointers will help you to gauge if a development has room for price increment or even a potential drop in price. So point 1, you got to check the current status of the project in terms of the numbers of units sold or the numbers of percentage sold. For instance, if you are looking to purchase a project that was launched 2 years ago and that has already cleared maybe 80% of its inventory, chances of the developer reducing the price for the remaining 20% is actually quite low because developers' financing has been secured and the balance 20% are likely to be used by developers to make a profit from. That said, it is important to understand what prices were the first 80% sold at, and you'll be able to make an even more informed decision. Point 2, you gotta check the recent sales activities. So how has this new launch sales performance been? How many units were sold in the past week or in the past month? Are these a healthy number? So a project might be only 10 to 20% sold, but if they are experiencing a healthy amount of transactions, say 5 to 10 units per week or even 50 to 60 units per month, it is unlikely that the developers will drop price given such status. Place yourself in the shoes of a developer, or if you are a seller today and you receive plenty of viewings and offer, will you actually want to drop your price? I guess not, right? So last but most important factor, and this is gonna be a lengthy one, it is actually about developers' profit margin. Knowing the developer's profit margin can help you to determine if you're entering at a safe entry point. And so how you calculate their profit margin is by knowing what is their break-even price. Okay, let's take for example Margaret View, a development located in Queenstown with a break-even price of 1,516 PSF. I guess it's understandable that if developer sell below this price, they'll be making a loss, and if they sell above this price, they'll be making a profit. When Margaret View first launched in June 2018, the average transaction price were at 1,889 PSF. That is close to a $400 of profit margin. Should you enter during the initial launch, there is a risk because the entry price is far from the break-even price. June 2018 was also a period where there were a lot of new launches in the market. Developer could have charged an even higher price, and buyers would still be willing to pay because due to the lack of supply. But soon after, there was a steep drop in price due to the implementation of cooling measure. Your ABSD went up and your LTV went down. If you have noticed here, wherever the transaction prices come close to developers' break-even price of 1,516 PSF, prices tend to slowly increase. Another such example is Tre Residence, which is a 3 minutes walk from Aljunied MRT. I think that's quite a fantastic location. The land was purchased in January 2014 with a break-even price of 1,256 PSF. It's first launched at an average of close to 1,600 PSF. That's a profit margin of $300 to $350. Not long after, there was a drop in price due to competition. Year 2015 was a time where there were a lot of supply of new launches. Months after Tre Residence was launched, Sims Urban Oasis, which is only a 3 minutes drive away, launched at an even lower PSF. So Tre's Residence developer had no choice but to reduce the pricing. Sales remained slow, transacting only 1 unit per month. So developer had to further reduce the pricing. And if you have noticed here again, prices tend to increase whenever the developer sell close to its break-even price of 1,256 PSF. This is a point where it's safe for you to enter, but if you are able to spot units that are transacted below this PSF, that would be a bonus. So now I will show you projects where prices do pick up. This is Grandia Park Residence, located next to Tanah Merah MRT. Its break-even price is about 1,238 PSF. It was launched in 2017 when en bloc fever started and there was an oversupply of new launches in the market. This developer was quite sensitive about the pricing because they wanted to launch at a price where units will move. So they started to sell at an average of 1,400 PSF. That's a profit of approximately 160 PSF, which is relatively low. What you'll notice here is that developers launch in phases. Once they hit a certain percentage of sales, they increase the prices progressively. And when developer does this, they are helping buyers who purchase during the initial phase. Case in point, Gem Residence. It is located a 6 minutes walk from Braddon MRT and has a break-even price of 1,232 PSF. Let's zoom in to Stack 7 and you will understand how developers' pricing strategy can benefit you as a buyer. So level 28 of Stack 7 was sold at 1.3 million in May 2016. A year later in May 2017, its neighbor downstairs on level 25 was sold at 1.4 million. So obviously there is a slight increment in price because a lower level was sold at a higher price. Then another year later, its neighbor upstairs was sold at 1.6 million, a difference of 247,000 for one level jump. Interesting, isn't it? The last unit to be sold in this stack was on level 35, which was transacted at 1.8 million, approximately 2,000 PSF. In a matter of 2 years, prices within the same stack surged by 40%. I suppose a lot of us wish to enter at the initial phase where prices are still close to break-even, but at this junction, there's bound to be uncertainty because the number of units sold is unclear, and we don't exactly know if the units will move. So phase 2 is relatively a good time to enter because it ticks the boxes of having a good number of units sold, frequent weekly transactions, and developers' profit margin is still acceptable. And so in conclusion, if at the point of a purchase, the project you have selected already has a high percentage of units sold with frequent weekly or monthly transactions and close to break-even price, it is definitely safe to consider. If the project is at a stage where there is a low percentage sold, high profit margin, or a high percentage sold and a high profit margin, you gotta be cautious. Other considerations such as demand and supply will come into play, but I will leave this to my future upcoming videos, so please stay tuned. Till then, don't forget to subscribe to my YouTube channel. If you are watching this via Facebook or Instagram, to turn on your notifications so that you can be alert when the next video is ready. See you!